Well, it looks like the United States has finally gone and done it. Nothing is going to stop these tariffs, and we need to understand what's on the horizon for the global economy. Honestly, we didn't think Trump would go through with it, or at least not in this manner. Everyone speculated that maybe he would, but this time he really pulled the trigger. And he isn't targeting the usual adversaries like China or Russia. Instead, he's hitting his own G7 allies. This is a crash course into how G7 nations, in particular, are overly dependent on trade with the United States. Seriously, what did they think would happen once Trump realized that 60, 70, or even 80% of their trade hinged on the American economy and its consumer market? Of course he was going to weaponize that, and Canada should have seen it coming. It already faced Trump's tariffs back in 2016, and from then until 2020, there was a lot of volatility and commercial threats. Canada should have used that time to diversify its supply chains and customer base outside the United States. And now, what do we see? They're being hit with a 25% tariff, something very damaging to the entire economy. There's a big volume of materials trade, especially petroleum, flowing from Canada to the US, and a 25% tariff is enough to choke that flow. It's not only American consumers who will have to pay this added tax, they might simply stop buying from Canada. Canadian exporters could be forced to absorb the tariff's cost by lowering their prices, which would hurt many Canadian industries and jobs. Let's be clear, most of Canada's oil exports go to the United States. All their infrastructure, pipelines, and refineries are primarily designed to sell oil to the US at a significant discount. Even right now, Canada isn't getting the maximum possible revenue, and because their system isn't oriented toward exporting to other countries that need more oil and gas, they're in a very disadvantageous position. If we look at the global picture, who needs energy right now? Europe, which has lost Russian gas and is going through de-industrialization, needing to import more oil. But Canada has been stuck with the US for too long. What can Canada do at this point? They threaten to respond with equivalent tariffs, but the most damaging move they could make would be to cut off the supply of oil and gas to the US. If they did that, the fallout would be disastrous for both sides. For starters, somewhere between 90% and 98% of Canadian oil is exported to the US, and if that supply stops, the repercussions would be enormous in Canada. The oil industry would be devastated. Meanwhile, in the United States, about 20 to 30% of refining capacity depends on Canadian oil, which means prices for gasoline and diesel would rise substantially. Even though Trump has promised to boost US oil production, actually tapping more shale would take 6 months to several years. On top of that, oil companies would be doing it in an environment with high interest rates and high inflation, making the process even more difficult. This trade war between the US and Canada is going to wreck both economies. As for Mexico, the situation is a bit more complex. We know Mexico is essentially the factory south of the US, producing countless products for American companies. For example, many John Deere tractors are made in Mexico and then shipped to the United States. But Trump has never been thrilled about that arrangement. He's threatened John Deere with huge tariffs unless they bring production back to the US. By setting this 25% tariff, Trump has made it clear to Mexico and the entire world that he wants to restore manufacturing industries in the United States, regardless of how it affects his trading partners' economies. The big question is, will Trump keep that 25% tariff in place for the next 4 years? If he does, the cost of cars and manufactured goods in the US will remain high throughout that entire period. Or will he use this as a bargaining chip with Mexico, demanding, for instance, that they reject Chinese investments like those from the company BYD? The key issue is whether Mexico will cave under US pressure because Washington wields a lot of influence in the Western Hemisphere. I mean, they're right there to the north, so that's a huge factor. What are Mexicans really going to do about this situation? Will they strengthen ties with China? I think that would be the smartest move. But if they do, they'll have to brace themselves for a big temporary hit to their industries and economy. Nevertheless, Chinese companies can always come in, build more factories, and export to the rest of the world from Mexico. Mexico could then become a key Chinese partner for exporting to Latin American markets. Let's not forget that countries like Brazil and Argentina are growing fast, and many Chinese products, including BYD automobiles, are already making their way into Latin America. So it's perfectly conceivable for Mexico to break away from the US and align with China to stand up to American pressure. But will they do it? That's the big unknown right now. For me, it's a coin toss. Now for the most interesting question, what is China going to do? China exports a vast amount of goods to the US, more than $500 billion a year, and that figure is sure to drop. A 10% tariff may sound small, but in certain sectors where profit margins are thin, 10% is enough to kill any incentive to keep exporting to America. The first effect is that US consumers will have to pay much more for daily items. There's a meme, which is actually a fact, stating that 70% to 90% of Walmart products come from China. So when Americans go shopping for groceries, furniture, toys, or even some foods, all those items will get more expensive. Even Trump knows you can't punish China without facing serious consequences. If he didn't, instead of a 10% tariff, he would have raised them by 60% or even 100%. He's not doing that because he realizes it would trigger a crisis, or at least he'd have slapped a 25% tariff on China like he did on Canada and Mexico. But the main issue for the US isn't just the drop in trade, it's that China is pushing its own domestic consumption. Over time, this will be a game changer. If China decides to strengthen internal consumption, several things will happen. First, they'll have to stimulate their economy. And where will that money come from? Well, China can always issue bonds, borrow from its citizens or from abroad, but more likely it'll use its huge trade surplus, which has been built up through trade with the US and the rest of the world. Every year, China generates around $1 trillion surplus. With a 10% tariff, that might drop to 800 or 900 billion, but it's still a massive amount that can be used to boost domestic consumption. China is already implementing programs to drive consumption, such as issuing vouchers to citizens or offering subsidies of up to 20% for purchasing electric vehicles. Basically, the US just shot itself in the foot. It's astonishing that Trump can't see the side effects of this decision. If China decides to utilize those American dollars to strengthen its internal consumption, what do you think will happen to the US Treasury bond market? China won't finance its own isolation. It won't simply take its trade-earned dollars and put them into American assets. Even ignoring the threat of those assets being frozen, like what happened with Russia, China knows two things will occur. First, the US will keep devaluing its currency because this plan of reindustrializing via tariffs isn't going to work. Trump will need to further devalue the dollar, and if China holds too many treasuries, it will lose purchasing power. Rather than invest in the US, China will redirect its funds toward Belt and Road projects, stimulate domestic consumption, and raise living standards for its own people. What the US has effectively done is confirm that China is on the path to becoming an even bigger consumer superpower. If China controls the world's supply chains and its consumer market keeps growing, what does that mean? It means China will become an even larger global economic powerhouse. So what does all of this mean for those of us living in various places around the world? It means we need to prepare for a global currency crisis. The value of our currency, whichever it is going to drop. And it's important to understand why. A shortage of US dollars is very likely as a result of these tariffs. We have to grasp the mechanism here. Nowadays, every country trades bilaterally with others. Yes, China does have commercial agreements with Australia, Singapore, and many others, but most of global trade doesn't really operate that way. The US dollar still reigns supreme, whether we like it or not, or whether it's fair or not. That's just how the system functions right now. If the US decides to set tariffs at 10%, 20%, or 60% on imports from other countries, it means the US will spend fewer dollars on foreign goods. As a result, the flow of dollars from American consumers to global economies will shrink drastically. Exporters will receive fewer dollars, which will impoverish these countries, not only in terms of tax revenue, but also in their access to dollars. When that happens, we see events like what's been unfolding in Europe, where the euro has plummeted. The same goes for Brazil, whose real has weakened, or Australia's dollar, which is also under heavy pressure. The Japanese yen is weakening as well. We might see a replay of something like the 2022 monetary crisis, leading to a steep rise in local inflation across numerous nations. The problem is that the system is set up so that every country owes money to other countries, and many of those debts are in US dollars. To pay their creditors and bondholders in dollars, countries will need to find ways to get dollars. The only realistic way to do that is by selling their own currencies on the open market to buy dollars. That will drive the dollar even higher and further weaken their currencies. It's a vicious cycle, and Trump has just triggered it. The long-term consequences will be extremely harmful, not just for Trump, but for the United States as a whole. In the short run, the US might win this trade war. It might look like it's working for the next few months, or even for the next 4 years, but in reality, we'll see a major diversification effort. The BRICS countries will align more strongly with China, whose economy is growing at a faster pace than nearly anywhere else. In terms of supply chains, China is already more insulated from the US, so these tariffs won't hit them as hard. This leads us closer to a scenario of greater de-dollarization. In the past, China tried to convince other countries to ditch the dollar in international trade, cautioning them that something could happen. It suggested they switch to their own currencies. Now Trump has just validated all of China's warnings. He's basically said to the world, China was right. If the US can do this to neighbors like Mexico and Canada, what do you think it'll do to everyone else? Looking ahead, we're moving toward an extremely polarized world. This will even affect investment in the near term. Maybe there will be a spike in purchases of American assets because plenty of people will seek refuge in dollars. But in the long run, as countries drift away from the US consumer market and build up their own markets and stock exchanges, especially in China, the dynamics will change. What Trump has done is undermine America's economic future. Yes, it sounds harsh. Slogans like "Make America Great Again" might sound appealing, but looking forward, I don't think this is a good strategy. On a related note, one crucial aspect that often goes unnoticed is how shifts in major currencies can influence global confidence. If more nations opt to settle trade in local currencies or pivot to alternative payment systems, we might witness heightened volatility in foreign exchange markets. That would add another layer of uncertainty for investors and businesses planning international operations. Gold and silver, having historically served as safe havens in times of monetary disruption, could see a surge in popularity. Moreover, the ongoing expansion of digital currencies, particularly central bank digital currencies, CBDCs, raises new questions about the future stability of the global monetary order. If the US continues down this path of aggressive tariffs, it might accelerate a transformation in how nations choose to hold their reserves and conduct cross-border transactions. In the end, while the short-term implications of tariffs are straightforward, raising consumer prices, fueling inflation, and sparking retaliation, the deeper, more significant consequences might be the dismantling of long-standing financial structures we once took for granted.